Welcome back to another episode of the Vet Worthwhile podcast. I am James Yost, partner and wealth advisor at SignatureFD, and I'm joined as always by my co-host Travis York, owner of 3-1 Advisors. Travis, how are you?
I'm doing great today, James. How about yourself?
I'm doing well. We are back with another episode of the Vet Worthwhile podcast. Super excited to bring you this recurring guest of ours. We have with us SignatureFD Chief Investment Officer, Tony Welch. Tony, how are you? Thanks for joining us.
I'm doing well. Thanks for having me.
Excellent. I would be remiss to not also say hello to our phenomenal co-host, Travis York. Travis, what's going on in your world?
Not too much, James. I guess we're starting to gear up for college football season.
Oh boy. I mean, the other day I was going to a morning workout and, it just smelled like fall. I don't really know how to describe that. I don't know if you guys picked it up. Maybe it was a little too early for you guys to be up, but it was fantastic. And, I'm super excited about the football season. So with that, why don't we just dive right in? I don't want to talk about the football season too much because our special guest is a Florida State alumni and diehard fan. So we'll just breeze right past this and edit this piece out, move right into our line of questioning. So,
James, I was hoping that part wouldn't come up today, but, that's okay. My Saturdays have freed up dramatically already.
Perfect.
That's a good way to look at it, Tony. You're 1 week into the season, not even week one, and you already know you got your Saturday afternoons back.
That's right.
Hey, silver lining to everything. So let's dive right in, Tony. I mean, the world has changed a lot since the last time you were on about 6 months ago. So we were hoping to just get an update from you on a couple different ideas, a couple different topics. I mean, our listeners are very invested in a lot of the content that we're about to put in here today. So let's dive right in. I mean, what's the current situation that you're seeing on the inflation front?
Yeah, inflation is going to be top of mind because the reality is price levels are high. When we look at it, just a broad basket of goods, which is certainly not totally encapsulating the veterinarian industry, but a broad basket of goods is up over 25% since about mid-2020. And so you think about that, the price levels are high, and that's not changing. What is changing is that rate of inflation has eased quite a bit. And I think if you look at consumer confidence metrics, you'll see the consumer is pretty downtrodden, and a lot of it does have to do with the prior inflation we've already seen and that not really easing up. But nevertheless, we have seen the rate of change come down. What we look at, various different indices, inflation's running at about 2 to 3% right now. Some real-time inflation trackers that we look at are even showing rates of inflation that are under 2% today. So again, not to confuse price levels with the rate of change, but rate of change is what matters for Fed policy. It's what matters for investors, really. So that's kind of where we are on an inflation front.
So maybe if we could just take that out of the investor and put it on Main Street, Tony. We're not going to see people all of a sudden now that, inflation is down to under 3% or 2%. It's not like people are going to go, oh, wow, I've got all this extra money floating around in my pocket, right? How long do you think that it takes for that to start to level out where consumers don't feel like those inflationary strains? And then the follow-up on that is with some of these inflationary constraints, we've seen people maybe be, a little bit less prone to spend money in the veterinary hospital. So, I think there's just a lot of interest in when are people going to feel like they've got more money in their pocket?
That's just such a good question, Travis. And I think it all comes down to what's happening with real wages. So we've got nominal wages, and nominal wages right now are running at about 4%. And you strip out inflation and you've got real wages of about 1% right now. And that's actually pretty decent. 1% real wage growth is pretty decent rate of growth. But you contrast in 2022, consumers lost something like 6 or 7% of real spending power. Their wages went up about 6% less than inflation did. So it's going to take some time for consumers to really make up for those real losses that they experienced. And to your point, it's happening now. They are making up ground on inflation, but they're not anywhere near what they lost in 2022. I would say on the current trajectory, it's probably going to take, another couple years here before people feel like they're fully kind of back to where they were from a spending power perspective.
Yeah, and I've always, anecdotally, it's the number that I've always heard, and I believe this is based on research and polling, and it's something that's studied. It's not just something that's kind of off the cuff, but people can't really feel inflation when it's below 2%. Like they can't tangibly feel like things are more expensive on a year-to-year basis. That's what I've always kind of heard. Part of the reason the Fed has that 2% target. Speaking of, let's kick right into that. I mean, we've been talking on this podcast about private equity and multiples in the veterinary space and how that's tied to interest rates, which obviously are based upon, at least on the short end, what's happening with respect to the Federal Reserve policy. So, Tony, why don't you piggyback off the conversation we just had on inflation and give us an update on where the Fed is with respect to their policy decisions?
They're about to cut interest rates, right? So we shouldn't speak in absolutes all the time, but Jay Powell just had his press conference at Jackson Hole. And the overriding message there is that they feel more comfortable with the trajectory of inflation, but they feel less comfortable with what's happening in the labor markets. So we need to remember that the Fed does have a dual mandate. It's price stability and it's full employment. And we're in and around full employment, but they're starting to see some cracks in the labor market data here. So we look at things like the hiring rate. So the corporate hiring rate has been falling. It's at a pretty low level now. The quits rate is low. And you might think, well, why does that matter? Well, if you're not confident in your ability to get a new job, you're not going to quit your current job. So a low quit rate, that tells us that consumers don't feel like there's strong availability out there. And then I mentioned those wage gains. We talked about that a little bit earlier. Wage gains of 4%, that's pretty good, but that's coming off a level that was much higher than that. So wage gains are starting to slow. So the Fed's kind of looking at that total picture and they say, okay, well, inflation looks to be more under control right now. We're confident that the rate of change in prices is pretty stable, but the labor market is now where we need to shift our attention to. So that Fed cutting cycle is likely to start here in September. I think they've discussed that once they start cutting, it's kind of that's significant because it starts the beginning of an actual easing cycle. And all that means is that more cuts are on the way. Before I kind of pause there, I will say that we want the Fed to be methodical in their rate cuts. You don't want to see, I know mortgage rates of 6.5%. A lot of people would like to see those lower in a hurry. However, when the Fed's cutting rates quickly, that usually means that this economy is in a recession. So we kind of want to see the Fed methodically lowering their policy rate, maybe getting 150 basis points or so off of the rate over the next 6 months or so. That would be kind of a good bogey for them.
Okay, so 150 basis points. Is there a rate that again, I think we lived in such a low rate environment for so long, Tony, right? Like it almost created like a false reality in what type of rate indicates like stability in the economy and where do they like to see it, maybe go up 50 basis points and down 50 basis points. Is that realistic or is it always going to be kind of this like large pendulum swing?
Well, I could get incredibly nerdy with you, Travis, and talk about R-star. So if the listeners want to go Google R-star, I'll save you all the nerdy discussion here right now. But basically, the policy rate that's kind of consistent with stability in the economy is probably going to be in that 3.5% range. And that's kind of where the Fed would like to get. So that's about 200 basis points of cuts. And they'd love to get to a place where they could get there and hold. Now, the reality is that the economy goes through cycles. It goes through expansion cycles. It goes through recessionary cycles. And that's why you see the rate fluctuating around that level. They're cutting when we're beyond that rate, when we're in a recession, and they're hiking above that when they think inflation's a problem.
And the thesis, obviously, I'm assuming, Tony, is that they never want to get to a point where they kind of run out of arrows in the proverbial quiver in order to quell some sort of darkness ahead. Yeah.
That's right. I mean, if you go, one of the consequences of the post 2008 environment was they're sitting on a 0% interest rate for a long time. So there's really not much they could do except for just buy assets, basically pump money into the system. They couldn't do anything from a rate perspective. So I think the Fed definitely wants to avoid that type of scenario again. They want to give themselves some ammunition in case things start to weaken from an economic perspective.
That's a good segue. Let's get into the economy. I mean, like all these things are obviously connected. We haven't even talked about the stock market yet, but like, what are you seeing with respect to macroeconomic data? And I know we talked a little bit about some of the cracks in the jobs data, which I want to come back to because that's super important. And anything we can do to tie that into small businesses, that would be great. But for now, what are you seeing from a macroeconomic data, at least in the US?
So the broad summary here is the economy's holding up for now, but that doesn't mean that there's not these cracks. So something like the manufacturing sector, that's pretty stagnant right now. The housing sector, pretty stagnant right now. The consumer, they're still out there spending. But if you listen to Q2 earnings calls, they're being more selective in what they spend on. So there's these cracks that are out there. But all things considered, the economy's still growing because the reality is real wages are up and the consumer is spending. And then that's kind of the natural state of this economy. And as long as that kind of continues to be the case, we get a place of economic growth. So we'll see if some changes in interest rate policy kind of help to spur, and heal up some of these cracks. But for now, that's kind of the bottom line is right now you've got an economy that it's growing. It's probably a slow level of growth. It's led by consumer spending, but it's becoming a more discerning consumer.
Interesting. So like if you take that, Tony, and obviously, most of our listeners are focused on the healthcare veterinary side of small business. Like, what are you seeing and what do you expect for small businesses as a whole over the coming, 6 to 12 month period?
Well, I mean, you can just go straight to the source. I mean, they do a small business sentiment survey, the NFIB, that's the National Federation of Independent Business. So they go out and they survey small businesses on a variety of topics. And small businesses, they don't particularly love where they are right now. And that shouldn't come to much of a surprise to anybody. They've been hit by labor shortages, and then they've been hit by inflation. And now they've got a softening economy that's kind of hitting their top line. So they're kind of getting hit by all these kind of directions that have been negative. So their present situation, they do not rate as positively. But in the last survey that went out, they actually upped their future expectations component. So small businesses, and it jumped by the most since COVID in 2020. As soon as the vaccine announcement came out, you saw small business optimism spiked at that point. So we had a jump in small business optimism. But if we kind of see this small business optimism continue to progress through, that would be an interesting sign. But I would say kind of as we think about small businesses, they've obviously gone through a difficult period of time, kind of getting hit by all those negative factors, but at least they're starting to see some light at the end of the tunnel.
Okay, well, I'll maybe use that as a segue to talk a little bit because, again, thinking even specifically about our veterinarians, generally small businesses, and we saw this kind of bigger umbrella of private equity enter that space. So, transitioning the connection between private equity and small business, it's happening in a lot of different businesses. You obviously spend a lot of time kind of looking at both because they both impact the economy. What's kind of your general feel and sense of the private equity ecosystem and where is private equity going?
Yeah, I mean, that's a big question in terms of a lot to unravel there. So I'll just try to kind of give a broad overlay of the land and we can dig in wherever we want to. But in general, private equity fundraising over the last couple of years, it's down. It is definitively down. This year's been a pretty soft year for fundraising for new capital commitments in private equity. And what happened is you really got a peak, this peaking of private equity commitments in 2021. That was an incredible year for fundraising. And it's really fallen each year ever since. And if you think about what's going on under the covers, 2022 was a really hard year for pension funds that are big investors into private equity. I was having a conversation with our director of investments here just the other day because he comes from a private equity specific background. And I was like, hey, what's going on here with the fundraising? Why are they struggling so much? And he noted that because of those commitments made in 2021, both stocks and bonds fell in 2022. So if you think about that, pension funds have allocation policies. So they were all of a sudden massively over allocated to private equity. So for the last couple years, they've just put no new money to work in private equity, trying to get their portfolios kind of back into balance. So you've had really not much in the way of fundraising, but you do still have a lot of dry powder out there. So there was a lot of fundraising in earlier years that still needs to get deployed. And what we're seeing with that is we've actually seen less buyout activity, so less kind of new investments in the private equity space. And we're seeing more add-on investments where they've already got a portfolio company and they're supporting that portfolio company. Again, I mentioned all the issues that small businesses have had, and they're supporting that company through those issues, hopefully to get out to the other side. So I do, Travis, to your point, I do think that whatever transpires in the upcoming years is going to matter quite a bit for getting new fundraising, for getting some of this capital off the sidelines into new ventures rather than just add-on ventures, and then the exit market. And we could spend a lot of time talking about the exit market as well.
Yeah, let's get into that. For our listeners, the words private equity is probably a pretty new thing. I mean, it hasn't been that long since private equity was really prevalent in the veterinary world. And so, for a lot of people, getting them acclimated with the terminology and how these funds work, and a lot of these companies started deploying capital in, the late teens. And, as we know, there's a specific timeline that they need to typically exit those initial investments. And it sounds like from what you're saying, what a lot of folks are doing is maintaining those levels, the specific portfolio companies, adding on bolt-on investments, whether through secondaries or some other medium. They're not really getting out like they had historically. Ultimately, a lot of these portfolio companies have gotten so large, and there's FTC issues within the veterinary world, that there's not necessarily going to be a solution where the private equity backed consolidator can sell their stake to another one of their competitors to form a strategic partnership, but instead they're going to have to pivot to the IPO market. So there's some buzz around the community right now of a few things that are going to potentially happen there. So what are you seeing right now within the IPO space with respect to volume and multiples?
Well, for 2024, it's not good, right? So the story for 2024 is not great for the IPO space. So you look at this company, Dealogic, they track kind of all that type of activity, and they're showing that public listings, so IPOs, were just 2.3% of all exits in Q1 of this year. And to put that in perspective, that number is about 19% of all exit activity in a normal year. So almost no IPO activity in the first part of this year. And when we just talk to some of our PE partners, they've kind of honed in on this 2025, 2026. There's a lot of uncertainty in 2024. We mentioned the political backdrop. There's uncertainty there. So that's what a lot of what we're seeing from the IPO space is really not a lot going on from a offering space or perspective here in 2024. But once we kind of get through some of the political uncertainty, once we kind of get through to the other side, 2025, 2026, it's quite possible that starts to pick back up.
Interesting. So I guess also you kind of raised another question, maybe that some of our listeners may have, Tony, is they partnered with one of these private equity backed consolidators in 2021, and they were maybe shooting to recap in 2023 or 2024, and that hasn't occurred because of the current market. How does that play out just in that ecosystem if, some groups are trying to push to go IPO, but, maybe instead of, I almost want to say like an oversupply of groups are trying to exit it at one time. What happens in those situations?
Well, what would, kind of standard market theory would tell you that multiples would have to come down if that were the case. But, when we look through historical data, we've got PE data through multiple market cycles, and I don't suspect that it would be as dire as we might kind of anticipate. But, all else equal, if a lot of firms are trying to come to market at the same time, you just have more supply of firms coming to market. And, supply demand 101, and you kind of see a hit to multiples in that situation.
A couple things, Tony. One is kind of circling back here because you touched on this briefly, and I just think it's timely because this is something we're seeing in the news. And I hope you're glad we didn't bring you on a month ago so that you had to do an hour on the yen unwind trade. But what's up with the latest jobs report that everybody's freaking out about? Can you give our listeners some context around what happened with that revision and, how that ties into the current jobs market?
Yeah, I mean, so the BLS, they go back and revise data. They take a look at data every year and see where there needs to be revisions. And they went and revised back 12 months of jobs data down by 818,000 jobs. What that works out to is about 68,000 jobs a month were revised away. So essentially, numbers that we were getting at that point in time, you got to adjust them down 68,000 jobs. And that's through March of this year. And when we look at that, we still had healthy job creation in that period of time. It just wasn't this gangbuster, robust pace of job creation that was being reported at that point in time. And honestly, it really just corroborated a lot of these other indicators of the labor market that we track, right? So we did see the unemployment rate has been starting to rise. We have seen wage inflation softening. We have seen consumers saying that jobs are getting harder to get. So the revision really just went back and corroborated something that we've kind of known along the way, is that the labor market was in a space of softening. You still have a little bit more labor demand out there than labor supply, but generally that gap is closing. And what ends up happening is once the labor market softens sufficiently, you don't just go into a recession out of nowhere. Like I said, the general state of this economy is to grow, is for people that have a job, they go spend money, and the economy grows. But what happens is you become more susceptible to if you get a negative shock to the system, right? You don't have as much cushion in the labor market. And that's kind of where we're getting to right now. If you held my feet to the fire and said, what are the recession risks over the next 12 months? It's something north of zero, something south of probably 40%. So I think over the next 12 months, there is recession risk on the table. And it's just because a lot of that labor moat has cleared.
Well, and I hate to jump off of that and jump back and forth, but you said something on the IPO side of things that is interesting, right? Because we started to unpack some of the veterinary hospitals going to the IPO, and I didn't get the question in before we jump to the next one, but I think it's important in my mind for our listeners is when you start thinking about a veterinary hospital platform becoming a publicly traded company, how do you think about what type of company is that? Does that equate, is a veterinary hospital the same as investing in a computer, software as a service, Salesforce type business? Are there comparable businesses that you think from a performance perspective, you may try to put a veterinary hospital platform inside of, Tony?
No, I don't know if I'd put it in kind of a software as a service type platform, but I think you can kind of look at it more on that broad healthcare spectrum. There's some publicly traded hospitals out there. You can kind of go back, look at their metrics. Certainly wouldn't just look at the healthcare sector writ large. A lot of what comprises that is you've got managed care, so you've got kind of the insurance industry and stuff like that. But you can go look at public comparable healthcare, more like hospitals that are out there today. But I'm not so sure that it kind of fits into kind of software space.
But what do you generally see then at a high level, Tony, when a company goes from owned privately to a part of the participant in our public markets? What do you generally see with respect to like EBITDA multiple?
You know, in the healthcare space, I think right now you can probably look at something in the low double digits for healthcare type companies. Obviously, if you can kind of situate yourself in like kind of the fast growing software areas, that's where you're getting multiples in the, high teens, 20 range or something like that. But I think you can kind of sit in the low double digit range there.
Very interesting.
Yeah. I mean, I don't know, James. I think that's a really good place to think about wrapping up on my end, because that to me is a big question that, time is going to help us see where a publicly traded veterinary hospital will rest. And, it'll be fun to bring Tony back in 3 or 4 years and hold him accountable to what he predicted.
Yeah, absolutely. Yeah.
I do look forward to that. And hopefully there is plenty of prosperity to be had here in the future in the veterinary space.
Awesome.
Absolutely.
Thank you so much for coming on, man. It's been great catching up with you. Any parting wisdom you'd like to give to our listeners? Anything as we approach a presidential election? Anything out there that you think would be helpful as they think about managing and running their businesses in the middle of it seems to be a pretty volatile election cycle?
No, I mean, I would just offer encouragement in terms of, I do think when we look at the survey for small businesses, I'm very empathetic to the struggles that businesses have had. Like I said, it really has been a 3-pronged attack here, where it's been inflation, it's been labor quality and availability, and more recently, it's been kind of some softening on the revenue side. But I do think that the skies are starting to part. We do have some, kind of better days ahead for smaller businesses. So let's hope that I'm right on that accord.
There you go.
Hey, I love the encouragement on small business. And, anybody that wants to send encouragement along to Tony's Knowles, send an email to James or I, and we'll be sure to pass the encouragement along.
Thank you, Travis.
Awesome. Well, this has been another episode of the Vet Worthwhile podcast. Tony Welch, thanks again for joining us, my friend, Chief Investment Officer of SignatureFD. Travis, good to see you as always. Y'all have a great day. Thanks again for tuning in to the Vet Worthwhile podcast. You can find us online at signaturefd.com/signatureveterinary. And then our ask would be, if you found this episode valuable, just think of one friend or colleague that you think would enjoy the content, and just please share. So thanks again. We'll see you next time.
Travis York is the owner of 3-in-1 Vet Advisors and a partner of SignatureFD. 3-in-1 Vet Advisors is a veterinary consulting and strategic planning firm of which SignatureFD has no involvement or ownership. James Yost is a partner and wealth advisor at SignatureFD. SignatureFD is an investment advisor registered with the U.S. Securities and Exchange Commission. 3-in-1 Vet Advisors and SignatureFD are not affiliated. Mr. York provides all non-investment advisory services through 3-in-1 Vet Advisors. The opinions of the guests and the contents of this podcast are intended to be educational only and should not be relied upon as investment, tax, business, or planning advice. You should consult with a professional advisor prior to taking any course of action that may impact you or your business.